morning, good afternoon, or good evening, wherever it is that you are watching this from. My name is Rina Hicks, and I'm the COO at Faida Investment Bank. And as we usually do, and as is our tradition, every quarter we come on here as Oak Special Fund and give you an update of how we have performed. And so we're here to just share with you, and discuss our performance. There's a previous video we've done where Ian has kind of just broken down our performance, but now we want to go into detail and just sort of look behind the numbers, compare with other ETFs and other asset classes, and just sort of see how we've done, so that you are understanding and know how the performance and understand the performance. So just to give a highlight in case you missed that other video, the first half of 2026, that's January to June, our performance between that time was 8.06%. That's an absolute number, meaning that's what we have returned to investors in that period. That works out to an annualized return of 16.77%. So that was the first half. So I'll come into quarter two. For quarter two, we had a return of 3.19%. So let me break that down. The 3.91% in the 3 months. In April, we had 1.64% absolute. In May, it was 0.61%, and then in June, it was 0.91%, giving a total quarter return of 3.19%. But from January to June, it's 8.06%. So I just have with me here two of my colleagues. One of them is Titus Kimeu, who is our head of distribution, and then I also have Ian Kahangara, who is our Chief Investment Officer and Director Global Markets. So I'll start with you, Titus. And, since we issued statements, and, as we usually do, by the way, in case you are watching this for the first time, we're the only special fund that provides statements monthly. And our promise, Titus, is to be transparent, right?
Yes.
And so that transparency has resulted in some reactions. And so I wanted to ask you, and my first question to you is, what are some of the questions or comments or reactions that you've received from our clients based on the return that we've had this quarter?
Awesome. Thank you, Rina. Thank you, everyone. It's such an honor to be here and articulate the concerns that our clients are having. Statements are a reflection of performance, and of course, there will be subsequent questions that will arise from those statements. And we appreciate concerns. Clients' concerns are genuine, they are legit, and some of the key things that clients are asking Rina is, are we on course to our target net return of 20% per annum?
Yeah, and I love that question, because we are just halfway through the year. And we're at 16.77% annualized. So the answer is yes, but I will allow Ian, who is our Chief Investment Officer, to talk into detail and sort of just tell us, are we on course, Ian?
Okay. Good morning, good afternoon, good evening, depending on where you're watching from us. And it's a great time again meeting new people. I would want to just address the question directly and say, are we on course? And I will say yes. Why? We have a target of 20% return after fees as our yearly return. Last year, we were able to achieve 18.99. So with a minimum deviation from the mark. But this year, we are determined to get up to 20%. So if you look at our performance, especially the first quarter, the first quarter was a good quarter. But as we ended up to closing the quarter and came to the second quarter, it was a very different time. And with time, I'll explain especially how assets have behaved, different assets have behaved, and especially in the global markets where it has been quite volatile. So we did take a more conservative view and reserved our exposures to ensure that we preserve the capital rather than aggressively looking for returns. And that's why you'll find that the second quarter may be a bit lower than what you saw in the first quarter. But having realigned with the current market, global macros, we are now targeting better quarter 3 and quarter 4 to make sure that we are still aligned to our target of 20%.
Yeah, yes. Which I guess is interesting. I mean, if I was having a conversation with someone and we're looking at the NSE, the Nairobi Securities Exchange, and you can have 3 different investors all trading in the Nairobi Securities Exchange having completely different results based on the choice that you make. And what I hear you saying is that you chose to take a conservative approach. Maybe let's just dig into that a little bit. Why was the reason for taking a more conservative approach as opposed to being a lot more aggressive and taking a lot more risk?
Okay, I look at it from various ways. And a good example is to say with volatility, there are chances of making money, but the more chances are there for making money, there are more chances of losing money.
Okay.
And I'll give a good example of maybe what is known as the Standard & Poor's 500, which takes actually 500 companies from the US stocks and see how it has performed versus maybe how other markets have performed. If you look at it from hindsight, the S&P has actually performed 9.55% from January till date. But looking at it assuming the whole fund invested in it, and we are at 9.55, that's actually, once you use the geometric mean, we are actually at 20.01%. So ignoring management fees, we would have said that we have achieved. That's what we would have said. But how would it have looked on your statements on a month-to-month basis? How it would have looked, because we've had very volatile period in terms of, if you look at the performance from January, and it will be shown on the screen, the graphs, we'll see that on January alone, the S&P actually rose by 1.37%, which is actually slightly lower than what we performed as a fund. But by February, we had a negative 0.87%. It actually dropped.
The S&P?
The S&P. By March, it was further down by 5%. So anyone who was investing in S&P, and S&P being one of our benchmarks for our fund, actually January to March, it was on a negative. It was on a negative. So assuming we had said we believe in it, we are buying and we are holding, by March, our clients will be complaining, how can you just keep on giving us losses? But by April alone, we had a shoot of 10.42%. And after that, we had a slight drop in May of 5% from now the top of April, and a negative 1.09% in the month of June. So give or take, actually, someone who had invested 1 million in January, the highest they would have gotten was in May, which would be 1.107. The lowest for the portfolio would have been in March, which is 953,000. So they would have actually lost their capital. But by end of June, they would be at 1,095,000, which is a 9.55% return. So what am I trying to convey when I'm giving these statistics, and you'll see it on your screen? What we are trying to say is, as a fund, we have what we call active portfolio rebalancing. Our work, as much as we want you to make the most, and we can decide we believe in S&P, we're going to invest in it. You guys wait for 1 year and we'll discuss after 1 year. But the volatility in between the months, we have to mitigate against it. And that's why when you look at our fund, as much as some months may have low returns, we've not had a negative return. Why? The times when you have downturns, we have to exit. There's a cost to entry, there's a cost to exit in terms of commissions and other charges. Yeah. Then when we see now we are on the right track, that's when we get back to those asset classes. And other examples I'll share within this video. Thank you.
Thanks, Ian. I think that's helpful to see. I'll come back to you, Titus. What's another comment or question that you're receiving from clients?
Awesome. Thank you, Rina. Thank you, Ian, so much. Clients are actually human beings. I don't always say that. So they'll always respond. They'll always react. Once they receive the statements, they'll put a comparative analysis. I know some of them are analysts, and say, Titus, there is a lot of volatility on these statements. Can you speak to that, Rina?
Yeah, sure. I'm happy to speak to that. And perhaps maybe let me start by saying one of the things that is completely unique about Oak Special Fund is that we've chosen to give statements monthly. That means you see your returns on a monthly basis. Now, whatever market you're trading, whether you're trading gold, you're trading Kenya, the stock market in Nairobi, you're trading the New York Stock Exchange, wherever it is that you're trading in whatever asset class, markets go up and down. Interest rates are up and down. Returns are up and down in every single market that you are trading in. And therefore, an account that is trading in a stock exchange or any market can never have a straight line. Even your bond market, if you bought bonds in Kenya, if you look at net asset value of your bond account, it will move up and down depending on where interest rates are going. And so Titus, in response to that, it is impossible for us to have a straight line where returns are concerned because markets go up and markets go down. In fact, if you ever saw a statement where it's a straight line and there's no movement up or down, then you have to make a few questions. You have to ask a few questions because then that's something that is questionable because we're in the markets and we're trading markets. However, I want to also allow Ian to speak into that. I know he did talk about S&P 500, which is an exchange-traded fund that tracks 500 of the biggest companies in the US, and he's talked about their performance. But yeah, maybe perhaps you can speak to us specifically. Why do we see that movement up and down between the months?
Okay. Thank you, Rina, for that question. And I'm happy to be here to actually explain. The first thing is I'll actually reflect on a workshop that we had with the Capital Markets Authority, where it was actually a big concern whereby most special funds have been sold as MMFs, which is money market funds. We have to recognize that money market funds behavior and the way they are tied to interest rates is very different from special funds. That is number one. Number two, various special funds are different in how they asset allocate their goals and actually their target industry. So you'll find some may be more skewed on risk and high returns. Others will be moderate risk and returns can vary. And some will be skewed to actually having more consistent returns. So what happens when you find that on your statement, you are finding this time, give or take, you are getting a return of above 20. The next time you are getting a return of 7. Another time you are getting a return of 14. Are you ready for those returns? Are you able to absorb those returns? Is that what you are looking for as a client? And the answer is, especially now looking at our Oak Special Fund and what we've had this year, we'll first say that we have to look at what is the global space, what's the global universe in which we are investing, and particularly which assets are we investing. If you look at our benchmark, which are 3, first is the Treasury bills, 2 is the Standard & Poor's 500, and 3 is the NSE 20. If you look at them as isolated asset classes, how volatile were they within the year? The good thing is first to look at one, which is the Treasury bills. Treasury bills have actually started gaining slightly, having come in January, the 91-day T-bill having closed at 7.7%. We went to a low by March of 7.53% when inflation started kicking in. And now we have, by end of June, we had our 91-day T-bill at 8.90. So that one was a slight decline and a slight top-up increase to just 3.90% from where we started in the year. So that one was moderately flat. But remember, that is where we put maybe our last idle cash. Because looking at those rates, and we are targeting 20%, that's the list of the places that we want to place our money. Now, looking at the other benchmark, which is the NSE 20. The NSE 20 year to date has done 23.36%, which is great in all ways. But if you look at the volatility within those 6 months, we had crazy volatility because we started the year in January with a very good beginning of the year at 5.10% as it was a bullish trend. Then in February, we had 13.67 as the change between January and February. So overall hitting actually at 18% year to date by end of February. But by the time we went into March, we actually dropped by 8.50%. So looking like if we had put everything on the NSE 20, we'd actually have had a negative month in March. April was a small positive of 3.38%. Then May 0.1% or 0.17%, which is actually lower than what we reported. And then June 8.97. Why am I bringing all these figures? And these figures are on your screen. The reason is for you to see other asset classes. How volatile are they? How are the changes? The changes are massive. So if you compare this, and the last one that I'm going to put up is even gold as an example. Gold, by the time we started the year, and everyone was sure, there is political uncertainty. What do? You buy gold. That's the best, safest asset. But what happened? Actually, people skewed more money into oil. Others, some of the central banks actually exited their positions to liquidate, to get more assets to buy other, to diversify. So gold first started with a bull run in January and February, having 9.31% in January and a further 10.6% in February. However, by the time we went to March, March was the biggest decline of 10%, 10.85%. April, we also had a decline. May, we had a decline. Then June was the worst with 12.07%. Year to date, since the beginning, we have actually a negative 6.97% on gold. Now, what happens in our actively rebalanced portfolio? What we do is, as much as we invest in all this, and for gold, we are able to short, so we are able to make our money even when it is going down. It is our work to look at the market and to ensure that when there is too much volatility, we bite what we can chew. We don't go aggressively overexposing the fund, because as much as we can make more money by exposing in these volatile assets, the same way something can happen and it can trigger a big loss. So our key driver is, first, mitigate losses, preserve capital. Number two, give a return that at least shields you from the normal inflation. Number three, now give above market returns. And that is what we are striving to. And we believe at 16.77% half year, we are still much above inflation. We've mitigated losses. No month we've had any negative. And actually looking forward, we believe we'll still touch the target of 20%.
Yeah.
Thank you.
Awesome. Thank you for that. Yeah, always good to look at other markets and to compare other asset classes and their performance and see how are we doing against that. Titus, I want to come back to you one more time.
Yes.
And what's another, question, comment that clients are giving you?
Thank you so much, Rina. Thank you so much, Ian. Clients will always be worried. Is my money safe? Oh my. That's a question every client I interact with, even the clients my team interacts with, will always ask, are my funds safe?
And that's a very important question. In whatever it is that you're investing in, risk is one of those questions you must always, I always say, if there's a question you must always ask, it's risk. How safe is my money? So that you can make a decision whether to invest or not, whether you're being promised 30%, 100%, 5%, is my money safe? With Oak, I'd say, yes, your money is safe, as Ian has just articulated really well. Priority number one is capital preservation. We're not in the business of losing people's money. Then priority number two is to give you a return above inflation. Priority number three is to give you, maximized returns to the extent that we can with a target of 20%. That's our priority. Is your money safe? Yes, it is safe. Even when you look at our distribution in terms of asset classes, when we chose to be conservative, you will see, in fact, you will get our fact sheet fairly soon, and you will see that almost 60% of our investment is in cash and cash equivalents and government securities. And you will see that the risky assets are much less than that. I also want to just speak to two things. And the first one I want to speak to is the fact that this company, Faida Investment Bank, has been in the region and in the business of capital markets for the last over 31 years. We have a combined experience of people, traders, who have a lot of experience in the capital markets, who've seen markets come, markets go, asset classes come, asset classes go, and we are regulated by the capital markets. We are not in the business of seeing our clients' money go. Because if we do that, then we'll be here for another 2 years, and that is not what we want. We want to continue to grow in this capital market and beyond. In fact, our vision, Titus, as you remember, is Africa's future funded. In fact, I'm really excited. We're going to be announcing a few things soon concerning that vision, very, very soon. I think the other thing I want to talk about concerning safety of the investments is the fact that people need to understand what special funds are. You understand what I'm saying? It's important before you make a decision to invest, that you're not investing money you need for school fees next month. Because special funds are different. And the reason they're called special funds is because the regulator realized that we need to offer investors a different way of investing that accommodates a lot of creativity. Let me put it that way. And so they created a class of unit trusts that allows for flexibility. Flexibility in asset classes, flexibility in regions, flexibility in basically investing. And so you can virtually have a white canvas as a financial professional and decide, what do I want to invest in? And imagine what you will, come up with your proposal, an investment memorandum, share that with the CMA. If they like it and they agree and they see that it's a good idea, you get an approval as a special fund. And so when you look at special funds, they all vary, they're all different in their strategy and in the way that they invest. And therefore, with ours, we've come up with a strategy that is based on what we think will work and get us the target that we desire. So is your money safe? That is what we are prioritizing. Safe money. However, we are targeting 20% return in our investment. So a special fund is special in the sense of flexibility in the way that we invest. We don't guarantee returns. We don't guarantee that we will constantly have the same return over and over, as we have taken time to explain, but we are targeting higher returns than a money market fund, than a treasury bill, because of the expertise that we have built around being able to get into markets and out of markets so that we can give our investors the highest return possible. I hope that helps to alleviate your clients' fears around safety.
Thank you so much, Rina. Yeah. I think that comes and plays a long call in terms of reassuring you investors that we are working towards ensuring that safety of funds, number one, and also achieve the return that we're targeting to achieve. Thank you so much, Rina, for that.
Thank you, Titus.
Thank you.
Yeah, so Ian, people are wondering about what's the outlook? What are we seeing for Q3, Q4? It's been a very volatile market in terms of just market activity. We've had a war, we've had huge issues just globally, generally. But, for the fund, what's our outlook as you look at Q3 and Q4? What would you say?
Thank you for that question. First, I want to say what happened in Q2. What brought the returns that may seem a bit lower than even Q1. It was a cautious approach that actually led to that. And what happened globally? First, we had the US-Iran war that was also had Israel involved. And literally what happened is we found foreigners exiting most of the markets. So like imagine markets, there was a lot of exit. And what happened? What literally happened was the stock markets were hit. Inflation went up, oil went up. And with oil going up, what happens? Domestic borrowing rates shot up. So that's why you find some of these things that we are discussing, they're not assets in isolation. They're connected to the real world. Like now, if you look at just the Kenyan market as an example, which actually translated to most of the emerging and African countries, we found that the interest rates on treasury bonds had gone down, then all of a sudden turned to go up. Stocks, where we entered a market where we are bullish, and actually even majority of the foreigners were in the markets, they exited to just retrieve their cash. And what did that do? Immediately they retrieved to get their cash, they made the stock market actually drop. The same thing was seen in US and other markets. There are few exceptions like Zambia, which I think because of a lot of minerals being mined and they've had a boom year. in terms of how they are growing, and actually their currency has gained a lot against the USD. That's an outlier. But largely, majority of the economies were affected. But what happened as we went to the end of Q2? It seems that all these jitters and the war and everything else were neutralized. People realized no matter what, we need the basic things. We need to continue with life. And it's like they've ignored the war. The war is continuing on the sideline, and things are continuing. I remember very well, let me just give an example of someone who called me when shares of KCB started dropping at 72. And they told me, should I sell? Should I sell? I think I should sell. And I told them, okay, there's no problem. Why are you selling? No, because they're going down. I asked, okay, once you sell, where are you taking the money?
Yeah.
The question is, where are you taking the money? Is your job being a trader that, okay, it's okay, you can sell, then you buy immediately, it goes down, will you continuously analyze? Or are you looking at a 2-year outlook? And I can tell you after that, the shares went down to 67. As we speak right now, they are at around 78. They've gone back up. So markets are cyclical. They'll go up and down. So what has happened is we've realized that the market now has muted, let me say, the geopolitical risks that you have right now, and the markets are continuing. So looking at that and having rebalanced our portfolio and reduced even our durations in the fixed income markets, right now we are now at a place of, let me say, launch to better things for the fund. So what do I expect for Q3? Q3, I literally expect a better returns by far, because we've moved from too cautious to more moderate stance, let me say, going forward. So I expect better returns as we go forward, less risky markets, but more aggressive maybe in more global space rather than local space as we proceed. So the outlook is actually looking good, and it's the right time actually to invest, I would say. Yes.
Yeah. So I don't know whether you agree with Ian Titus, but for somebody who's kind of like on the fence, they're wondering, should I invest? Should I try these guys? They're on the fence around investing in Oak Special Fund. What would you say to them?
I like listening to the experts, and the expert has just spoken and given a very impressive outlook of the markets for the next Q3, Q4. So for those who are still hesitant, you're missing out. It's time to go in now. Revamp that portfolio. Welcome, please call us. We'll be ready to walk the journey with you. Thank you so much, Rina.
Yeah,
thank you so much, Ian.
Thank you,
Titus. As we're coming to sort of wrap up, Ian, what would you say our fund's promise is to investors?
Thank you, Rina, for that. I'll go back and first emphasize on our 3 T's. So one being transparent, trust, and tactful. If we look, we still remain transparent. We still continue giving monthly statements. I know everyone is on the fence. There are people who prefer more silence, and others prefer knowing more. Others would wish even if we can give daily statements, if it was possible. But we still adhere to our transparency, and will continue. Transparency should not be misunderstood to mean weakness or to mean a small downfall is a loss of track. And a good example is last year. Last year, we had one of our lowest months, being July, where we returned an annualized return of about 7%. However, by end of the year, we still returned 18.99% for the year. So we are still on track. And I want to tell you, same thing here. As much as we may find some months being lower, we are still on track. In terms of trust, first, you can trust that your assets are safe. You can trust that when you come to redeem or whatever you've invested, you will get it, and you'll get what is reflected on your statement. Third is tactful. Our team is tactful in terms of risk mitigation, being our primary goal. We will continue mitigating against any risks that may come, and we'll first prioritize risk mitigation versus returns. So let's not look at returns. That saying of high risk, high return, but we are more focused on mitigating the risk than return. what's our promise to our clients? We'll do the best that we can to give the best returns with risk-adjusted. We'll actually give risk-adjusted returns as we go forward.
So thank you very much, gentlemen, for that. It's been a great time just sort of discussing the markets and understanding where we are. But just finally from me is to say that short-term volatility is not the same as long-term risk. Our focus, ladies and gentlemen, is structure and governance, irrespective of what's happening in the markets around us. Structure and governance. And our promise for transparency doesn't change when markets are changing. Whether markets are hard or markets are fantastic, we will tell you how we have performed and it will be real. The governance that we have is such that we can't even lie about what we've done. You will see it in the way that we show it. Now, our promise is transparency, tactfulness, and trustworthiness. And that is what we live by. And we will continue to do our very best to give you the best performance possible. I wish you all the best on your investment journey, guys. And if you haven't joined us yet, please try us out. You will be happy for it. My name is Rina Hicks, and you have been watching this show from Faida Investment Bank and Oak Special Fund. Have a wonderful time.